Zach Miner along with my colleague Brenton Stransky. Brenton, what does U.S. crude oil imports from Norway have to do with drivers killed in collisions with railway trains?
Zach, I don't know, but I can't wait for you to tell us.
Absolutely nothing. The two things have nothing to do with each other. But I thought that this was a pretty interesting way to start the day by looking at squiggly lines look same. Those two things just happen to be very perfectly correlated since 1999 through 2009. The data points have very similar changes from year to year. And I thought that since we show a lot of charts that have correlation to them, that it's important to point out that correlation does not equal causation. And
Such an important
sometimes,
point.
and sometimes two things can look like they have a relationship and have no relationship whatsoever. And I thought that this was pretty cool. I just saw it on Twitter and thought that would be helpful to point out to our viewers that sometimes relationships appear to be there when they are not.
It's a great point. We can never be reminded of that enough in our business.
Absolutely. So just in case you're wondering, the crude oil imports do not have to do with railway train collisions.
Good to know.
So now I'm going to show you two other squiggly lines that happen to correlate with each other. And that is
But do they causate?
That's
not even
possible.
A term. I'm just making that up.
Yes, definitely. And that is the seasonality, the cycle of the seasons with the level of the VIX. And I think most investors have the idea that the fall has typically been the worst season for stocks. And you can see that going back, really since I believe this was 1990, so the last 32 years. It's got a pretty strong relationship that volatility tends to spike at the beginning of the year, tapers off during the summer months, and picks back up again in the fall, with again falling off towards the end of the year and the Christmas holiday. And this year has been no different. We had some volatility at the beginning of the year. It's tapered off through the summer, and now it's kicking back up a little bit again. So I just point this out just because that it wouldn't surprise me with all of the seeming complacency in the market, the strong run up that we've had year to date, that if we didn't see some spike in volatility going into the fall months.
It's been placid for sure.
Very placid. Absolutely. For sure. And if you kind of look back in history, the 2008, crisis kicked off in October, really actually September, October. Last year we put in the lows in October. So I do think that, as we start to kick into election year gear, which we will coming up in a couple months, we'll be 12 months out. We'll cover that on some future editions, but I wouldn't be surprised to see some increased volatility.
I'm excited you brought this up because it leads into a finance footnotes fun fact on a later slide.
Okay, love it. Going into the fundamentals, though, if you take the quarterly earnings calls and some of the things that CEOs and CFOs have been mentioning on those calls going back from Q2 22 through Q2 23, the big worries that have been talked about in the market, inflation, material cost, economic slowdowns, have all dropped precipitously since the second quarter of last year. And I think that you're really seeing that the most forecasted recession ever, the most forecasted economic downturn ever, has really not yet materialized. And companies are starting to, stop talking about, especially the economic slowdown. You saw that had, in quarter two of 22, had 40% of companies were talking about that on their quarterly earnings calls. Now that's down to 11% in the latest quarter. And the job cuts numbers, while that did spike a little bit in Q4 last year, really mostly centered around the big tech companies who did lay some people off. Even that's tapered off. So fundamentally, looking into what companies are saying, how they're talking about their views for the business, a lot of the big risks have kind of started to dissipate.
Do you think this has the same kind of power as like a consumer sentiment or investor sentiment? Obviously, corporate leaders are more optimistic than they were, 12 months ago, per your points. What do you think in the next 12 months? Is it a good sign or a bad sign?
Yeah, that's a good question. And if you had taken, I guess if you had looked at these numbers at the middle of last year, and you were just like most forecasters were predicting that there was going to be an economic slowdown. There was, inflation was high. There was going to be a slowdown because a lot of companies were talking about it. I think this may be a little bit of an outlier in the sense that companies generally have pretty good handles on their business. So if a lot of companies are talking about something, generally that does tend to materialize, and I think in this case it was a little bit of a counter indicator, and it's really started to dissipate a little bit. So I would say it, it could actually be a counter again, right? Because now they're starting to stop talking about
Might be
things like
priced in.
economic. It could certainly be priced in. That's kind of what we've seen through the first half of this year. Is a lot of the earnings revisions and press releases and just looking through to what they were going to say on their earnings calls has kind of been priced into the market. I mean, we're the S&P is up nearly 20% on the year, NASDAQ up far more than that. So I think that you have started to price in a lot of this dissipation, and you wonder, is it like, okay, well now is it time to get more defensive, right? Because now they're stopping to talk about it. So it's an interesting thing to see how the corporate leaders are talking differently about their businesses.
Great point.
So this next one, I did not know that. I mean, I knew it, but I didn't know it. The extent to which the public markets have shrunk in relation to the private markets. And I knew that, private equity had been growing for much of the last couple decades. In the 21st century, there's a lot more private equity backed companies that just don't go public. Typically the way to raise capital, in the past was to go public if you didn't want to take on debt. Now there's a lot of private markets. There's non-bank lenders. There's the shadow lending markets. There's a lot of different ways for companies to raise capital.
Access to capital, exactly.
Rather than to go public. But I didn't realize it was this much.
This is crazy. This is interesting point, Zach. If you look at like the Yale endowment model, they stopped printing their forward-looking estimates in 2021. But if you look at their their allocation to domestic stocks versus private equity, they have a 3 or 4 times greater allocation to private equity than they do publicly traded U.S. stocks, which goes right to your point.
Yeah, and you couple this with the fact that the market cap weightings of the public markets have gotten so tilted to the biggest companies that investing just in your indexes or just investing in your public market stocks is really kind of leaving you out of a lot of the economic engine of the country. When you have 4 times as many private companies as you do public companies, or 3 times as many private companies as you do public companies, you're kind of missing out on that if you're only focusing on public markets. So I hadn't realized it had grown this much in relation to the public markets, and I thought that was pretty interesting. And I also think it's interesting that they just put the Blackstone participation just as the little black line in there, which I guess is to indicate both their scale but also not their scale. That they actually, because everyone talks like, oh, Blackstone, they're touching everything. It's like, well, they're not really, actually. There's quite a bit of private equity money out there that's not Blackstone. But I thought that was interesting, and
they are big. Interesting about this chart, I think if you even look back, 20 years prior to the beginning of this chart, to the 90s or the late 80s, I think you'd see that green bar, which is the publicly traded companies, which are currently about 4,000. It was actually about 8,000, if memory serves, towards the late 80s. So I mean, it's come down by half. It's incredible.
Yeah, absolutely. And it seems to really kind of continuing that trend. And we did have a tick up in IPOs, during that kind of 2021 period where, interest rates were 0 and capital was, free money was flying around, and a lot of unicorn companies went public that a lot of them are doing absolutely terribly, at the moment in the public markets. And I think that partly, just speaks to some of the short-term nature, some of the short-term trading nature of the public markets these days. I think it's a lot less of the Buffett mentality where you would buy a company and hold it for years or decades, and a lot more of a trading mentality. You know, if you're a public company, you're forced, you know, you have to do a quarterly earnings call and report every quarter on your metrics. And I think for a lot of companies, it's just more attractive, you know,
Much
to really,
regulation.
yeah, and it's really just more attractive to not have to answer to the public markets every quarter. You know, you have to answer to your private investors, but it's not something that you have to, you know, release to the public every single quarter and be so short term with your thinking. And I, you know, I've always been a proponent, not always, but you know, I've become a proponent of perhaps a shorter or a longer earnings cycle. You know, maybe not necessarily needing a quarterly report, every quarter. I think that just encourages short-term thinking. It encourages potential misallocation of capital. It encourages accounting misadventures, you know, for folks to, you know, we had like the Adam Newman and, you know, WeWork with their non-GAAP adjusted, you know, EBITDA numbers that just made absolutely no sense.
Their alphabet soup of acronyms.
Yeah, absolutely. So I think that, you know, taking some of what is attractive in the private markets and trying to introduce that into the public markets, I think would be helpful, because this isn't necessarily a good trend, right? This isn't really a fantastic
I
thing
don't
for
think
the,
it's a great trend either. I think it's a great point. And I
uh,
think that, you know, for those watching, you can speak with your financial advisor. There are tools available to have you allow you access to these middle markets, these private markets. So talk with your financial advisor and see if it's a good idea for you and your allocation.
yeah, absolutely. And there is some push for some deregulation of access to these private markets, because, you know, a lot of them do have investment minimums, or they have net worth minimums in order to get access to some of these investments. So there is somewhat of a push to kind of democratize access to private equity a little bit, which I think would be helpful, because we want, you know, the broader public to have access to invest in the broader market and invest in the economy. So I don't love this trend, actually, by you know, as far as you know, access is concerned, and
But if we're talking about a
democratization.
silver lining, you know, I think that it is pushing, you know, more average investors, the non-high net worth folks. There are tools becoming available. So hopefully that's the silver lining, is
Yeah.
that there are opportunities to access these markets through the right advisors.
Yeah, absolutely. And it could be helpful just for an from the investor's point of view, to not think so short term as well, because, you know, as an advisor, you have these, you know, quarterly meetings and quarterly calls with your clients, and a lot of times it's easy to kind of, you know, miss the forest for the trees, where you're focused on what has happened in the last month or 3 months, and not necessarily focused on the long term. And you know, when you are invested in a private equity vehicle, those things don't mark to market every day. You know, I mean, there's a NAV that changes, a net asset value that changes, but it's not something where there's a price every single day of every single company that you're invested
I
in.
think that touches a great unknown, a great truth in investing. Investors unconsciously or subconsciously, they're paying a huge price for access to the capital, for
Yeah,
liquidity. So,
yeah,
I mean, it's a high cost, and you have to pay it through volatility. So maybe that's something to think about as you move forward.
yeah, absolutely. And the last one I wanted to look at here was another squiggly line equals another squiggly line. And this is the inflation path from 1966 to 1982, overlaid with the inflation path from 2013 to 2023. And it just kind of shows that, you know, they thought it was
It looks
done.
really scary, buddy. I saw this too, and I was thinking to
Yeah.
myself, this
You
is
know,
ugly.
this is kind of before Volcker had to come in and slay the dragon in the mid 70s and early 80s, where they thought it was kind of past them, right? They thought the inflation monster was back, you know, the inflation genie back in the lamp, and it wasn't. And there was a drastic reacceleration just a couple of years later. And I think that, you know, Jay Powell and the Fed know this, right? They're very aware of the historical, you know, consequences of not getting it done. And that's kind of why they've just been sticking to their tune. And like, you know, the market was calling for rate cuts next year, and Powell's like, no, like that's not even on our radar to cut rates. Like we
Dare
need
we
to make
say
sure that
the
this
four
thing's
most dangerous words in finance? This time is different.
this time is different. Right. Yeah, exactly. you never want to utter that phrase. So I just think it's something to keep an eye on, especially with the economy remaining strong, energy prices kind of remaining high. Oil demand. I saw a chart. Worldwide oil demand just broke through, all-time highs. So that's not great for inflation. So it's just something to keep in mind that I don't think we're nearly out of the woods with the inflation fight yet. And it just speaks to the fact that I think, rates will probably be higher for longer.
I think it's an awesome point, and you always want to hedge yourself when you make predictions, especially on a recorded podcast such as this. But that being said, might as well go out on a limb. My instinct is that inflation numbers will continue to come down, not at the rate they have, for no good reason. I'm not a genius. But that being said, one point that we're going to come back to on this podcast time and time again is just, what is the evidence of the mob? What's the mob mentality? What's everyone saying at the moment? And certainly the case that everyone seems to think inflation is going to continue trending lower, which is reason enough for us to perk our ears up and think, well, what if that's not the case? And this chart, as ugly as it is, certainly insinuates that might be an uptick in the future.
Yeah, for sure. What you got for us?
Well, great, thanks. I'm going to move over here to some exciting things, and I want to take a step back. I mean, I'm talking with clients now. August is ugly, or has been ugly. Not tremendously ugly, but uglier than the previous 5 months we had. So I have a chart here. This actually came from the Wall Street Journal this morning. And this is the three major US markets, the Dow, the S&P, the NASDAQ. And you're seeing there's been a regression to the 65-day moving average. Zach, you're a CFA. Can you tell us why 65-day moving average? Why not 50? Why not 200-day moving average?
I don't know.
No one knows. It's just this.
I've actually never seen the 65-day moving average.
It's just the way the Wall Street Journal, the nation's biggest newspaper, that's how they publish it.
Is that 3 trading months worth of days? Maybe 20. I don't know. Yeah, maybe that's it. 3 trading months worth of days, a quarter.
See, that's why we pay you, the genius, to be on the podcast.
Yeah,
so there certainly has been a regression here, a step back. It does create resistance. If you're a technical trader, that's something you talk to your advisor about. But I thought this is interesting. Coming back to the 4 Fs, the financial footnotes, fun fact, and this was in the journal this morning. This is the 6 months in a row that there hasn't been a 2% move up or down in the S&P 500, which is very rare. It hasn't happened since 2018, over 5 years. So we have had this very long, placid stretch for stocks, and it may not feel that way because we're all at the beach, and August has been a little bit slumpy, if you will, another technical term. But just to point that out, we have had a bit of a pullback. So leading into my next slide, last Friday was a big day. The Federal Reserve Chairman, Jay Powell, was at his conference, and he made a speech on Friday, and it changed the market's interpretation of what's going to happen with interest rates, which of course drive the economy, right? From your savings rate and to your mortgage rate. They're all affected by this rate that the Federal Reserve changes. And if you go back 2 weeks ago, the expectation for a raise by the Federal Reserve, by the market, right? The market was only 32% of market participants expected a rate increase by year end. But on Friday, that went to 54% expect an increase. So we saw a huge jump in the people that are expecting, albeit only a quarter point rise, so nothing seismic. On top of that, the market was expecting, to your point earlier, just a moment ago, that the Federal Reserve will lower rates at some point in 2024. And so as of 2 weeks ago, market participants, 84% expected there to be a decrease in rates by June of next year. And then on last Friday, it went down to 62%. So on this chart, I just have a graph here kind of reminding us how, while rates have shot up at very quick velocity, it's not too far out of line with the last 30 years of market data. So
yeah,
market perceptions are changing. Zach, what do you think?
Yeah, that's a great point. And I think that there's more to go with these change in probabilities. I think that the market was far too, I guess the optimistic is the word, that they were going to cut rates, even though if you think about it, if it would be optimistic, they would be cutting rates because the economy's horrible, right? So it's not really an optimistic scenario.
Until jobs jobs
right.
data, comes in less amazing. I mean, it's amazing right now. 50 to 60 years, best case scenario.
Yeah, it really is. So I'm not in that. I'm in the 40, the 38% that thinks that there will not be a rate cut before June of 2024. That's not that far from now. It's 10 months from now. I think they probably have more cuts or more hikes to go before then. And I think they're going to keep them high for a while. I really do. Absent some sort of credit event, which is possible, right? The long and variable lag, there certainly could be things percolating in the corporate real estate market or the banking system that we just don't see yet that could pop up, and
It's
cause
always the
them
case.
to make a change. But absent something like that, they're not just going to cut rates because inflation has come back down near their target for a few quarters, right? They're going to want to see multiple years probably of inflation being tamped down completely before they come in, absent some sort of real stress in the real economy, not in the market, for them to change that. So I think that these probabilities are going to continue to shift. But that was a big jump, right, in one day.
A big jump. And I think it's something to be aware of, that best guess from these two smart guys that rates will be higher for longer than maybe the market anticipates. So that being
Yep.
said, I want to go to my next chart, which is really intriguing. This is a way that I like to, and Zach, I think you do too. Just how do we price the market? Is it a good time to get in and invest? And one way to do that is a ratio called the equity risk premium. And it kind of segues very nicely with earnings yield. Okay. And this was published by actually LPL Research last week. And it was just talking about over the last 20 years, comparing the value of cash and bonds, right, on fixed income, considered safer investments than stocks. If you can tuck your money into the mattress at a 5 or 6% rate, there's obviously less need to invest into the stock market, right? So this tries to get at that metric, right? If based on stock valuations and bond yields. And according to that data, you can see it here on the chart, it's the worst it's been in 20 years. And then if you look at the earnings yield with the price to earnings ratio on the S&P at almost 22, which is relatively high, and a 10-year yield of 4.33, it's just been cause to be aware that things are pretty well priced, and especially as interest rates are less likely to go down in the next year. So something you have to be aware about as you're allocating your portfolio and talking with your astute financial advisors. Any thoughts on that, Zach?
Yeah, for sure. I think I'm actually I don't love the equity risk premium, primarily because if you took it at face value in the 1992 situation, you would be like, oh man, the stocks are horribly expensive. Let me, get drastically into bonds. And that was the complete wrong thing to do for the decade of the 90s, right? One of the best decades for stocks ever. But it was the right thing to do for much of the 2000s, especially from 2010 to kind of present day.
All of the fancy charts we show you on this podcast, this is just one of many, right? There's no one silver bullet, but this is one idea.
For sure. What you can do is look at it in relative terms, I think, to more recent history. So if you do look at it from, that 9/30/2011, right, that's 6.6% equity risk premium. That's basically telling you that stocks are paying you to take the risk over bonds, right? That's really what the equity risk premium is really for, comparing stocks and bonds, like where, how should you allocate risk wise? And what it's telling you is that that's come down to essentially parity, where stocks aren't really paying you anything for taking the risk over your 5.5% or 5% treasury yield. So I do think it's one thing to look at as far as if determining if, for a balanced investor, to say like, hey, should we be 60/40 or should we be that 80/20 portfolio that we were in for the last 10 years. Maybe it makes sense to go back to the kind of more traditional 60/40 where you are invested in bonds because they are paying you a return, and the premium that you get for taking on equity risk isn't really there.
Exactly. And just like price earnings ratio doesn't have necessarily a great correlation to stock returns in the near term, this is just one idea that we wanted to pass in front of you. And if you mention it at a cocktail party, you will sound awfully smart. So
absolutely.
I just wanted to point out that, there is some valuation shifting between the attractiveness of bonds to stocks. And I think that chart gets at that. I want to take a step back now, and I want to talk a little bit about some of the positives in the market. So we're talking about some of the negatives. Rates may stay higher for longer. The appeal of stocks over bonds, it's changing. But if we go to the next chart, this is published by, I believe, the St. Louis Federal Reserve Bank, but it's called GDP Now, and you can go.
Atlanta.
Is it St. Louis?
Atlanta.
It says right there.
St. Louis, Atlanta.
We'll edit this out. Just kidding. We don't edit anything out. This is the GDP Now forecast. Just making sure you're paying attention at home. Look at this. This is amazing. This came out 2 weeks ago. They make this estimate, I think, every 2 weeks, maybe they update the data. Anyway, We'll
Yeah.
edit that out as well. But you can see the consensus in the blue line. This is the consensus of the top 10 Wall Street banks versus what the Atlanta Fed is expecting for GDP, which is how fast the economy is growing. And you can see, like, my God, they're expecting a
Massive
huge growth,
spike.
a massive spike. So
Massive
for the
spike.
folks sitting at home, you've got a job, wages are improving, the economy is growing. Things look great. I think we have to take a step back and get away from the minutia sometimes and just be aware that things look pretty good right now. Um,
Yeah.
taking a
For sure. And if the GDP now is a volatile measure. I mean, it bounces around. Certainly, it's not a slow moving indicator. But if you're looking at treasury rates and you're like, man, why are treasuries they keep going up? It's because of this. It's because of the growth expectations have kind of lifted off from the prior anchored expectations of like low to no growth, where now Atlanta GDP now is over 5%. That's exceptional growth.
Yeah,
So
it's really great. And
yeah,
and then even the top 10 Wall Street banks, they're pessimistic on stocks according to some reports, but their overall consensus on the growth of the economy is improving meaningfully. So it's despite what we see in the headlines, things are very rosy now from many of the big metrics that we would follow, right? So that being said, I wanted in the last two charts I have for you today, I just want to make a couple quick points. And I was just thinking about this. Zach, and don't look ahead because I have a pop quiz for you. But the S&P 500 is down about 3%. This is this morning, and today being the 29th, Tuesday, it is seemingly a good day for the market. But I did want to point out that since the peak in July, as of this morning, market's down about 3%. We would need about an 8% gain to get back to our all-time highs, which were made in January of 2022. So we're closing in on 2 years since the stock market's made a 2-year a new high, and I think that's kind of lost in the media. I think it's kind of lost in the conversation. So the pop quiz for you, my friend, as of this morning, NASDAQ down about 5.5%. What best guess that the NASDAQ needs to return to get back to its all-time high, which was in November of 2021? Any
well, how far is the Nasdaq below its all time high?
no, what growth do we need to get
okay, right,
to?
okay, yeah. 12 to 15.
Yeah, it's 16.8 as of this morning. I
Okay,
think today's up
okay,
meaningfully. So that being
yeah.
said, if you're doing end of market, you're exactly on track, my friend, at 15%. We talk about it too. The NASDAQ had a great acceleration so far this year, but dang, it's still down 15 to 20% from its all-time highs nearly 2 years ago. So I think that's some good insight. And the last chart I'd mentioned to you is that since we spoke last 3 weeks ago, the investors have turned very, very negative, right? So right now I have this really beautiful chart from the American Association of Individual Investors. They publish data every week, and it's just a gauge of their members. How do you feel? And I have 3 arrows here for you, and I just want to point out that even going back a month, you can see that. Well, actually, I guess the all-time high was back in July. So just about a month ago, 51.4% of investors were bullish, meaning they think the stock market's going to go up. That was a 12-month high. And since that time, as of last week, it's fallen to 32.3 versus a long-term average of 37. So well below the long-term average of bullishness. And it's fallen significantly in the last week. 2 points. One, it shows you how fickle the average investor is. We have to stay the course. We have not to be swayed by the marketplace and our peers. We have to stay the course. And secondly, and please chime in here, Zach, this is a good indicator. This is if the mob is if everyone's doing one thing, you and I want to look at what else is the option. So if everyone's pessimistic, it tends to lead to good outcomes over the next 12 months.
Yeah, this one's definitely a contra indicator, and it's like all the numbers on here are almost exactly what you kind of would expect, right? The 1 year bearish high of 9/21/2022 was a couple weeks from the lows, right? If you had listened to those investors and kind of sold everything, you'd be in a world of hurt. And the 1 year bullish high of July 19th, like that might be like the day of the high, like the day of the highs. Of
It's
the
a
summer,
great
right? I mean,
indicator.
it's close. Yeah, I mean, it's close to it. So, this is actually one thing where it's like it's eroding to the downside, which tends to be a good, short-term buying opportunity. It doesn't necessarily mean that much for, years in advance, but It generally kinds to coincide with like overbought, oversold conditions where just, if the pain has just been layered onto you, this is going to erode, sentiment's going to erode. And that's generally, not the time you want to be, jumping on the wisdom of crowds, right?
We've
So
mentioned
others.
Carson Research before, and the former LPL economist Ryan Dietrich, yes,
Mhm.
came up with it on the fly. That's amazing. So maybe it was 18 months ago or so. Investor sentiment was the lowest ever, below 20, right? And so he published some great data at that time while I was still at LPL that talked about, what does it look like 6, 12, and 24 months down the road. So maybe we'll have that data for you next time when we
Yeah.
have our next podcast of Finance and Footnotes.
Excellent, man. Great stuff.
Well, it was great seeing you all out. We'll be back in a week or two. And as always, if you have questions, please let us know. Thank you, Zach. Anything else?
That's it, man. Very good. We'll talk again soon.
All right. Take care, everyone.
Uh,